I'm Holly McLean with A View from the Summit, and today we're here with Michelle Salazar with Litigation and Value Consultants. I'll get that out.
Yeah.
So, Michelle and I have been, she's been working with our clients for quite a few years, and also you've done quite a few evaluations for me as well. And today we wanted to talk about how to value a business. And so why don't you tell me a little bit about yourself and how you got started doing this?
Yeah, so I'm Michelle Salazar with Litigation and Valuation Consultants, and I got into this business 23 years ago.
Okay.
And I got into the business kind of by accident when I met my mentor who wanted to focus specifically on business valuation and forensic accounting. And so I've been doing this business for 23 years, and I realized that the importance of helping business owners is really the key. And what I realized is that business owners oftentimes don't really understand what business valuation means, the importance of valuing their business, and then how that value ties into their estate plan and their succession plan.
Okay. You have litigation in your title of the business, so how does that play into what you do and
Yeah,
your
so
experience?
oftentimes I value businesses when there's litigation involved. So if there's a partner dispute, if there's parties who are going through a divorce, I will attribute a value to their business so they can separate their assets in terms of divorce or buy out another partner in terms of a shareholder dispute. Also, the litigation aspect involves non-valuation type work like forensic accounting, economic loss calculations, things like that.
I think that would kind of also set you apart from a lot of other people that do valuations. They don't necessarily have to defend the values that they've come up with, and I imagine that you're used to having to defend your values.
Oh, absolutely, yes.
Yeah, I've always noticed in working with business owners is that they really don't have a value of their business. A lot of times they'll put the value of their business at what they think they need to retire and not what the business is actually worth.
Exactly.
What's your experience on with business owners and their valuations? And maybe you can also touch upon there are lots of different types of valuations and how that happens.
Yeah, so I think that oftentimes, since business owners don't necessarily understand how a business value is determined, they don't necessarily know the importance of the inputs to arrive at that business value. So I think in educating and working with business owners, what I've learned is that oftentimes they commingle their personal and their business assets. And what that complicates things is when they're trying to value their businesses for succession planning or for estate planning, it's very difficult to attribute a value because they're combined. So I educate business owners to basically say, hey, if you want to maximize your business value, first, maximize your cash flow. And second, make sure that your financials are really clean, and that when a business potential buyer or somebody who's stepping into your role comes in, that you have really clean records that are just business related and that don't have any sort of commingling between business and personal.
In our experience, we've noticed that a lot of times it's the first time that the business owner is selling their business, and their expertise is in the business that they're in, and almost all the time the buyer is generally the more sophisticated one and may have bought many businesses over the years.
Yeah, and I think the key there is the due diligence process. When you have a buyer who's coming in, oftentimes they have experience in your same industry. Oftentimes they've bought and sold various businesses in the same industry. And so again, it comes back to the importance of having complete and accurate and reliable financial information. For example, a buyer comes in and they're buying a company that's inventory intensive. One of the things I run into often is a business owner says, well, I can't provide you an inventory listing and I have no idea what my inventory is worth. And so from the buyer's perspective, that's problematic because they're buying an inventory intensive business and the owner has no idea what their inventory is worth. So that's just one example of, I think it muddies the deal and muddies the valuation process when you have unreliable, inaccurate, and incomplete information.
Yeah, I think a lot of small business owners that have inventory, all their inventory records are all just locked up in their mind, and
exactly.
It's pretty hard to equate a value to that unless you actually have that match up.
Right. And buyers and lenders, they all want to know that information. And, I get pushback from business owners all the time, like, why do I have to do that? Like, I don't want to go through and do a physical inventory count and give you a value. And I said, well, you're going to need to because they're going to want to know. It's important for that type of business.
Well, and I think it's important, even if you aren't selling your business, you really should have an idea of what makes up your inventory, what's moving, what's not moving.
And I think in the valuation process, it educates business owners on what's important to arriving at a value. So for instance, if it's a business owner who's never had their business valued, and this is the first time they've ever been asked for an inventory list and an inventory value, it'll be cumbersome up front, but moving forward, if they need another business valuation, they'll be prepared for what's coming. So I think that's something that is learned in the planning process is, here's how we arrive at the value, and here's what's going to be expected next time if you need a value in the future. So, yeah.
What about, we'll talk to business owners and they say, oh, well, it's a service business or whatever, and a lot of them will say, my business isn't worth anything. And that may not actually be true. There probably is some value in there. Can you kind of touch on that? And also, we get sometimes a lot of conversations around, blue sky and goodwill and so forth.
So oftentimes a service business, especially when people are getting divorced, there's a conversation of, I am the business. So if I weren't here operating my business, the business would generate no income and there would be no value. But when we're valuing a business for buy-sell purposes, we're using a fair market value standard. And what that means is that we're assuming it's a hypothetical buyer and a hypothetical seller, both willing to buy and sell under no compulsion to sell. So that means that we assume that even if the service provider leaves, that they are replaceable and that somebody else can come in and operate that business. So if they are one of a kind and they aren't replaceable, that answer might be true, but most often, mostly everybody is replaceable, and the value, we would still look at all of the valuation approaches, the assets, the cash flow, and the market approach to see if there really is any value to that business.
I noticed that when you start doing evaluation, one of your first questions is, well, what's the valuation for?
Correct.
A lot of business owners just say, well, you come up with a value and that's the value for no matter whatever it is.
Exactly. And that's not true at all. So the one of the first questions that we ask on every valuation is, why are you getting it valued? So for instance, if they're getting it valued for divorce purposes in Nevada or in any state, the standard of value is different. So in Nevada, the standard of value is fair value and not fair market value. And that the difference between fair market value and fair value is essentially the application of discounts for lack of marketability and then the lack of control discounts. So that's more complicated and in-depth in business valuation, but it makes a major difference in the value if you're valuing the same exact business for divorce versus buy-sell. So it's important to understand, why are we doing this?
What value, that situation, what value would come in higher then?
The value in a divorce situation would come in higher.
Okay. What about, we like to say there's basically 5 types of buyers: a family buyer, usually the lowest valuation; an employee, usually the next lowest valuation; Then we call it a value buyer, fair market value.
Yep.
And we say there's usually two types. A smaller value buyer that might come in and ask the seller to carry the paperwork to
Right.
self-finance it. And then the larger value buyer that's able to just write a check or already has financing. And then finally, a strategic buyer.
Yep.
And so that, you're talking about the same company. How is it that for each of those five, it could be a different value?
Yeah, so I mean, when I'm valuing a business under the fair market value standard, I arrive at an opinion of value based upon the three methods of evaluation, okay? And so based upon the financial information that's provided to me, I arrive at my opinion of what fair market value is. But that doesn't necessarily mean that's the strategic value, because there could be synergies, there could be a competitive advantage, there could be some uniqueness about the business that would generate a value in excess of the fair market value. And so I think that the strategic value is essentially what somebody's willing to pay for a business, even though the financials may not represent that value.
So they're usually going to, on a strategic purchase, they're going to usually pay a premium.
Exactly.
We had a client a few years ago that the fair market value was around $7 million. And we were talking to them and said, hey, we think it's more of a strategic sale, might even do better. And within about 90 days, we had a strategic buyer.
Right.
And it was $14 million.
Exactly.
And all cash, no contingencies. And the only thing that changed was the buyer. Nothing changed within the business standpoint.
Right. And that's not necessarily quantifiable.
Right.
Right. There's not a let's attribute fair market value and then let's attribute strategic value.
Yep.
It's just what somebody's willing to pay based upon their knowledge or what they know, what the synergies that are involved.
It's obviously important to have a good and accurate value of the business. And it's almost always possible to come up with that accurate value or range, I would assume. But I've seen it where they've completely missed the valuation and overvalued the company. We were working with a client that we came up with a value, and then they had their CPA do a value, and the CPA's value was probably about 50% more than our value.
Okay.
And then they presented that to the buyer, and the guy was like, well, you guys don't know what you're talking about. We have, our CPA said it's worth this much more. And of course, and then the deal imploded.
Okay.
And the CPA had applied a multiple to everything, including a multiple on the inventory.
Yep.
And, that blew up the deal.
Right.
And now 2 years later, the guy is still looking for a new buyer. And equally having the, selling yourself short. Your CPA could be great at tax returns, and you obviously are a CPA, but why use somebody that, what's the difference using somebody like you that has the credentials?
Yeah, so I'm often contacted by business owners for that exact reason. They say, I know that there's a multiple for my industry and it is 3 times EBITDA or it's 3 times gross or whatever they've heard from doing their research online or talking to their friends or whoever they know, right?
Yep.
And I think that oftentimes people who are their financial advisors, such as CPAs who don't do business valuation, provide them with an analysis of, if you're correct in your assumption of what the multiple is, here's how it applies to your financial figures, right?
Yep.
But my answer is always, that's a rule of thumb. It's generally an arbitrary method of valuation. And when you actually dig down into the financials and you make what we call normalizing adjustments to get to the true cash flow or the assets of the business, it's not very often consistent with the rule of thumb methodology. So I would never testify in court or provide an opinion of value. We're not allowed to, under our valuation standards, provide a value following a method such as a multiple of EBITDA or a multiple of gross.
As you go through those calculations, and then on top of that, then you do the research to find other comparable sales, much like when you're selling your home.
Exactly,
Right?
exactly. So under the market approach, we used two different databases where you pull comparable transactions by the same industry code.
Okay.
And so that's similar to what the business broker or the CPA is trying to do when they're arriving at a value
Yep.
using a multiple. But you're looking at the true cash flow of the business on a normalized basis, not necessarily the gross revenue unadjusted or the EBITDA unadjusted.
Okay.
So there's a lot of conflict in the industry about that issue.
What would you say are some of the common mistakes or pitfalls that not only professionals but business owners make in evaluating their business?
So I think that the biggest pitfall is business owners' lack of attention to detail to their finances. For instance, they often don't hire a bookkeeper who understands books. So they try to take an expensive route and they hire somebody who can do it inexpensively. And so the result is that they don't have accurate books. And so I think that one of the biggest pitfalls is having inaccurate books, which don't agree to the tax returns, and then not understanding just generally the overall finances of the company. I think that's number one. Step number one for any business owner is get your books in order, keep them in order, and make sure your books reconcile to your tax returns. And then if you have a potential buyer, you're already a step up from where most business owners are.
Yeah, I equate that to, flying an airplane. It's, those financials are your instruments.
Exactly.
And they are you. And we always like to say, if you can't measure it, you can't manage it.
Right.
And it's in my experience, we've always seen that businesses that don't have good books and records generally aren't that efficient and aren't that well run and aren't as profitable as similar businesses. And the ones that have it nailed down and the systems in place definitely are better run, more profitable, and almost always sell at a higher value.
It's the garbage in, garbage out concept, right? So if we're provided with garbage financials, the result will probably be inaccurate, right? And then also just being able to answer, if you don't have accurate financial statements, how do you know how much people owe you? How do you know how much, how far out the accounts receivable is? How do you know who you owe, right? How do you know what your inventory is and whether you need to order more? Things like that.
You said, they take the least expensive way, and I'd kind of push back and say that's really kind of the more expensive way to shortcut that, because you don't get accurate information and you can't manage it, and I would say it's much cheaper in the long run
to spend the money up front.
spend the money up front.
Exactly. Absolutely.
And so conversely, you could say, well, what's some of the things that really help a value in a business? And one would obviously be, good, accurate financials.
I think that organization. So in the due diligence process, there's typically a laundry list of documents that a potential buyer needs, right? And I think that the ability to efficiently provide responses to the questions is key. To providing internal financial statements that agree to the tax returns is very important. And then being able to provide support for the value of your assets, the support for the amounts that are owed to you, just the detail behind the numbers, and being able to intelligently talk about it or have somebody in your company who can.
I like to say that when you're operating your business, there are a bunch of things that you do that really don't add any value to the business, and conversely, they don't take away any value other than perhaps just resources and time. Other items that significantly decrease the value of the business, and other things that you do that enhance the value of the business. So I always like to call those value enhancers. What any of those that you kind of typically see, things that bring down the value versus increase the value?
I mean, if you just look at big picture valuation methodology, having no debt. So if you look at an asset approach, so there's three different approaches to valuation, and we look at all three methods and then we pick one of them.
And what are those three?
Yeah, so the first valuation method is the asset approach.
Okay.
And when we arrive at the value of a business under the asset approach, basically we're using a balance sheet which identifies all of the assets that the company owns, as well as all of the debts that are owed by the company as of a point in time, as of a specific date. And so if you're a company that has no debt, you're going to be worth more than a business that has debt, because assets minus liabilities equals your total equity, and the equity is equivalent to the value of your business on an adjusted basis. Okay. From an income approach, basically what we're looking at is we look at typically the last 5 years of gross revenue, net income, and cash flow. And the more cash flow that you have, the higher your cash flow, the more value that you're going to have in your company under an income approach. Okay. And then the third approach to valuation is the market approach. So there's two different things we look at. We look at gross revenue, and we apply a multiple to the gross revenue, and the multiple is derived from those two market databases that I talked to you about. Specific transactions in the same industry. But then we also look at the earnings of the business, and we apply a market multiple to the earnings as well. So the higher your earnings, the higher your gross revenue, the higher your value under a market approach.
Okay. I guess different standards or levels of valuations, and what are those, and what's the difference between them?
So that the first question that we ask again is, what is the purpose of the valuation? So our standards, we have certain reporting standards that we're required to follow, but if a person is requiring a valuation just for internal planning purposes, and they're not going to provide it to any outside users, they just kind of want to know, like, what is the ballpark estimate of my value? You can do what we call a calculation of value report. And the calculation of value report is the most inexpensive type of report, and it's often the report that my clients are the least happy with. And the reason why I say that is because it's a 2-page letter that says, this is not a formal opinion of value. This is only an estimate of value. Because I haven't followed my standard and done all of the work that I need to do, here is your range or estimate of value. And it gives all of the valuation schedules. So that's helpful for a business owner that just kind of wants a ballpark, that's not ever going to want to provide this report to anybody else, and who has somebody like myself walk them through the valuation process. The second level of report, and if you're doing a valuation for gifting or for estate tax purposes, you can't use that type of report. The next level of report is a summary valuation report, and that is a report that is most often used by me and my colleagues. And that's the type of report that provides a background of the company. It provides an explanation of the different methods of valuation. It provides an explanation of any subjective decisions that we're making as a valuation expert. And so basically a reader of that report would understand why we made the decisions we did in arriving at our final opinion of value. So in that type of report, you'd have, here's my opinion of value, and it's X. And then that's the type of report that we typically do if the IRS is involved. And then the third type of report is a detailed valuation report. And the detailed valuation report is the most costly type of report. And basically what a detailed report has is it has a complete written background of the national economy, the regional economy, the local economy, the state of the industry. It's a lot of background information that we're typically looking at anyway, but it's providing a written description of all of the things that we've considered. It also includes ratio analysis of the company as compared to the industry. So oftentimes that's helpful for a business owner to kind of see how their ratios compare to others in the same industry. And then it provides a really in-depth explanation of the valuation methodologies.
We started to talk about it earlier, but just on the blue sky, what is that? How do you come up with a number?
Yeah, so the blue sky is the ability for a business to generate cash flow or an income approach in excess of an asset approach. Okay, so when we're valuing a business, we come up with what is the value of the asset approach, and that's typically a floor value, right? If you had to go and sell your assets today and pay off your debts, how much would you put in your pocket?
Okay.
That's the floor value. Under an income approach, hopefully the value under an income approach exceeds the value of your net assets. And I always tell my clients that the difference between that income approach value and the asset value is essentially the blue sky, the goodwill.
I think that when we've talked with sometimes clients say, well, our business is going to be worth a whole bunch more because we're planning on doing this. How does that really affect the value on situations where they're wanting to base the value on something that is down the road?
Yeah. So typically when we're valuing a business under an income approach, if the future is indicative of the past, we would just rely upon the last 5 years of tax returns or financial statements to arrive at the value. But if a business owner comes in and says, oh, nope, our business model is changing, we've now gained additional contracts and our revenue is going to double, we can base the value on what we call a discounted cash flow model. And so you would be looking at 5-year projections, and you would calculate the present value of that future expected cash flow. The problem with that is that the projections can be manipulated. Obviously, if someone wants a higher value, they can manipulate the projections to create a higher value. So if I can avoid using future forecasted projections, I do, just because they're so speculative.
Okay. I've always been told that just discretionary cash flow is a really good value enhancer to a business.
Yes.
What would be some examples of discretionary cash flow?
So discretionary cash flow is essentially when you look at we calculate discretionary cash flow in each of our valuations under an income approach. So you look at the gross income, the net income, and then you look at what are the capital expenditure requirements, what you're looking at working capital needs, you're looking at principal payments on debt, because those are all items that don't necessarily impact a profit and loss statement. So you wouldn't see those numbers in the gross revenue, and you wouldn't see them in the net income. And so you have to make an additional reduction to get to the discretionary cash flow. And the discretionary cash flow is then divided by a capitalization rate to derive value. So the higher the discretionary cash flow, the higher the value.
Discretionary cash flow, and each dollar that you're adding to that is then, you could really say, is a multiple of increasing in value. Let's say you're using, 3 times multiple.
Right.
And it's like, okay, for every dollar you bring down, it's actually increasing the value by the company by $3.
Right.
One of the really most common things that we get when we're talking with owners is they say, well, I met with my CPA and we're going to have a bunch of taxes due before, for this year. So he said to go out and buy a bunch of new trucks and a bunch of new equipment. And they kind of do that every year as their tax planning. And we've had then buyers come in and look at it and go, well, geez, this company really doesn't make a lot of money, and you're always having to buy new equipment. Why would I, it's really capital intensive.
Exactly, because capital expenditures reduce cash flow, right? And so typically when we're valuing a business, we look at their depreciation schedule, like what assets have they acquired over the last 5 years. But in speaking to the business owner, if you talk to them and they say, well, we bought these assets because we were trying to reduce our tax implications, then you can make adjustments to that, to the valuation. But if you just take it for what it is, it would reduce the value of the business.
And I always say, when you're having to do less explaining on your financials to a buyer, the better off you are.
100%.
We, as you know, we do a lot of work in the qualified plan arenas, and like saying, and also my experiences working, involved with a bank and lending and so forth as well, that discretionary cash flow we look at a lot, and contributions to a qualified plan considered discretionary.
Yep.
And we like that because you can say, all right, here's the business tax return.
Yep.
Here's the tax return for the retirement plan, and
Yep.
here's your personal tax return. And all these numbers all link up, and when we're working with a business owner, say, look, the financials and these different financial reports, whether they're tax returns or financials or valuations, are really worth their weight in gold, because you want to tell a story to the buyer of why this is a good business to buy and why you're asking that value.
And the more the numbers add up and agree between the various tax returns, the better it is, because then it just doesn't cause any question about why don't these things agree.
Right.
Right?
Tell my clients when I say we really should get Michelle to do valuation, I tell them, one, she could care less about your business. She has no emotional tie. And this is really a third party, disinterested third party coming in and looking at it, and it's a fantastic dry run, dress rehearsal before you sit down in front of a buyer. You're probably going to pick apart their financials more so than the buyer.
Exactly.
And
absolutely.
And you're going to discover, right, hey, these are the things that people are going to want more data, more answers to.
Right.
And so that, I think, really helps prepare them to when they meet with a buyer. And it's always nice just to know, a lot of times buyers say, I get calls every so often about offering, and now that you have a real number, you can know if they're even in the ballpark.
Exactly.
How often, let's just say if you're managing a company, you're owning a company, and you aren't necessarily planning on selling it or transitioning for 5 to 10 years, but what's would be a good interval to refresh or update those valuations in a business?
So if you're just if you do your initial valuation just to get an idea of what your overall estate is worth, and you're going to retire in 5 years, I would say every 2 to 3 years.
Okay.
Because then from my standpoint, you just update a couple years worth of data versus waiting 6 or 7 years where your complete business model may have changed.
Yep.
So I think it's less expensive to update it every 2 or 3 years versus waiting 5 or more years.
And I think it's really good information back to you as an owner. What direction is your business going?
Exactly. How has my business changed? And if you do it every 2 or 3 years, you're familiar with the ins and outs of what was going on. Was it a COVID year, right?
Yeah.
If so, how did I expect that to impact my business?
I've seen also where the business owner is actually making more money, but the business value is actually going down.
Yep.
And how does that happen?
So I think that you can't just look at how much money is the business owner paying themselves, right? Because you have to look at, are they paying themselves a salary? Are they paying themselves owner draws or guaranteed payments? How are they paying themselves? But you have to look at all of the other profit and loss items as well, right? And the assets and the debts. So you can't just say, because I'm taking more, this business should be worth more.
Right.
You have to say, well, I'm able to take more for some reason, but what does the complete financial statements look like?
How does your customer base and your employees, how does that affect values? Do they have any effect?
Yeah, oftentimes I have clients come in and say, I have this great customer list and I know it's valuable, right? And there's a company in Southern California that attributes value specifically to things like websites, customer list, trademarks, patents. But that's a specialty valuation arena for intangible valuations. But typically, and it costs a lot of money, but typically really what it comes down to is if you have a great customer list, well, then that's creating the ability to generate cash flow, which means we've included that in the value under an income approach.
Okay.
So there's not a separate value that's attributed to a customer list.
Okay.
In preparing for this interview, I kind of thought about my client base, and I do have a client in the refuse business. And I've been doing a valuation for a potential buy-sell transaction, and I calculated the value under fair market value, and the buyer made an offer in excess of fair market value, and their reasoning is that the refuse company has franchise agreements in place, and the franchise agreements were recently extended for a period of 20 years. And so even though that cash flow and that income is included in the fair market value valuation, there was these synergies that enhanced the valuation or the offer price.
Thank you for coming in today and
Yeah.
talking to us about valuations and businesses, and we appreciate that.
Thanks for having me.
All right. I'm Holly McLean with A View from the Summit, and join us next time for another episode.